Check Podcasts.
Hi, I'm Bruce Williams. I'm the CEO of the Greater Victoria Chamber of Commerce. Welcome to Chamber Chats, coming to you as always from here in the podcasting studios at the Czech Media Group, one of our chamber champions. I begin, as always, acknowledging that I live and work in the ancestral lands of the Lekwungen-speaking nations, known to us as Songhees and Esquimalt, or Kosapsum, and they've been the stewards of this land for millennia. This is all made possible by the support of Island Savings, a division of First West Credit Union, who are redefining what banking can do for people, communities, and the world. We're going to talk with one of their professionals in just a minute here. So when you have investments, the money that you're putting away to retire with or saving up for whatever purpose it might be, the idea, of course, of investing is to make as much money as you can, try and compound that money. But people, when they make the decisions as to what they're going to invest in, are moving more towards ethical or responsible investing. And that's what we want to talk about today, the idea of making money but making a difference at the same time. Our guest on the program today is Daniel Marley. He is a wealth advisor with Island Savings. Daniel, how are you?
I'm doing very well, Bruce. Thanks for having me.
How much of a shift have you seen in even the last 5 years in people making those kinds of choices?
Yeah, I think it's predominantly come to the forefront here in the last kind of 5 to 7 years. Many of these ethical investments have been around for decades, but especially in this area with things like climate change and obviously some of the geopolitical issues that we're seeing around the world right now, they've certainly come to the forefront here most recently. But since the pandemic has really been the big ramp up, so seen massive growth in interest and lots of questions in the last 2-3 years. And it's really becoming table stakes now in a lot of the conversations we're having with members.
Yeah, I have to think that the signs of climate change have kind of clicked a lot of light bulbs off over people's heads too, right?
Absolutely, yeah. So we've seen the wildfires, obviously, flooding in recent years locally as well. It certainly does bring the E and ESG. So we talk about environmental and social governance issues, and the environmental piece obviously is the most prominent, especially with what we've seen over the last couple of summers.
So let's kind of define that ethical or responsible investing. What's that mean?
Yeah, so essentially what you're doing is just adding additional rigor to your investment decisions. So beyond just the revenue and profits and that money making that you spoke about, that compounding of return, you're really just starting to take into account some of the maybe positive, but often negative externalities that those investment decisions might bring into your portfolio.
So let's talk about some examples of that. What are popular options for people that you're seeing when they're wanting to do responsible or ethical investing?
Yeah, and so I think the genesis of this was what we would call negative exclusions. So it was really doing away with companies or investments in your portfolio that we really saw no positive externalities. And so things like weapons, military, gambling, pornography, nuclear power, mainly around that proliferation, that geopolitical issues, excluding those entirely. But what it did at the time, though, was still included things like oil and gas, parts of the world, maybe like China and Russia, where there might be some political issues. And so very baseline, they just got rid of those clean and cut. I think the biggest one is tobacco, obviously, where we see a lot of negative externalities, obviously, with smoking. And when those came to the forefront, it was sort of the idea of getting rid of those positive externalities right off the bat.
When you talk about geopolitical, that's kind of a factor that, for example, people may not want to invest in something that's Russian owned, for example. Is that what you're talking
Sure.
about?
Yeah. And so from the nuclear power standpoint, obviously climate's a big issue, as we just spoke about. Nuclear power is probably going to play some sort of a role there, but really that idea around proliferation of nuclear weapons, issues that we're seeing in places like Iran, and Russia most recently, they've decided to exclude things like that for the greater good. So the idea around us kind of ruining ourselves and the planet because of some geopolitical issue would trump that being part of the solution for climate.
Yeah. So when this assessment is being done to find out something is an ethical product or a responsible product, how deep is the dive into that? Like what sort of elements are looked at and considered?
Yeah, and so from the baseline, I mean, it is just those exclusions, right? That would be sort of table stakes for the conversation of getting rid of those ones with positive externalities. But the dive can get very deep from there. So we see portfolios now that are being built with fossil fuels being excluded from it. So the oil and gas sector not being a part of the portfolio at all. We see ESG integration. So the idea of just bringing the environmental, social, and governance issues to light on each particular investment. It could be impact or a thematic in nature. So looking at those positive externalities again, there could be environmental impacts that are measurable. So think about, amounts of CO2 going into the air or things like clean liters of water. There's even bonds right now that they're offering in the United States, green bonds that are actually helping to build some schools in underprivileged areas. You can measure the number of kids that those schools are servicing. So there's lots of ways and depth to how deep they can go into these investments. But from the very basic, it's the exclusions and then diving a bit deeper depending on personal preference.
Yeah, I mean, does it get forensic when you get to things like, okay, this company's doing amazing things to recycle or compost or reuse things like that, but their fleet of vehicles are still fossil fuel driven? Does it get that kind of wonky when you do this?
Absolutely. And it's sort of the nuance with everyone talking about net zero right now, right? Net zero doesn't mean that companies or investments aren't, net polluters or net negative contributors. It's about offsetting that damage. So, obviously, if that fleet of vehicles is still running on gas, they might be able to offset some of that with, wind turbines or powering a factory from solar. And so really when we talk about net zero, it's about getting to a neutral state, not a no state, right? And so that idea around a just transition, we're moving toward net zero, means that not every investment is going to be perfect, but we're looking for ways in which there are marginal improvement.
Okay, so we've made the decision that we're going to start investing in a more ethical manner. How do we then kind of source the companies or the projects that we want to invest in? Tell me about the sourcing process.
Yeah. And so investors that are sort of do-it-yourselfers, there are third-party rating agencies like a Morningstar or a Fund Grade that have started to implement some of these sustainability ratings, or think letter grades and things of that nature associated with either individual investments or maybe it's a mutual fund or an exchange-traded fund. So it is possible to go out, and subscribe to some of these services and be able to get a little bit more information on it. But from my point of view and from my sort of professional opinion, there's lots of professional money managers that are putting these rigors into portfolios. And so there's plenty of companies across Canada that are now implementing these into portfolios for investors. So again, depending on the depth of that dive, there's professional money managers out there who are sort of putting these rigors into the portfolio for investors.
Yeah, I mean, there are people that manage their own portfolio. I find them to be very brave people to do that on their own.
Absolutely. Yeah,
No,
sure.
but seeking help is, I mean, somebody like you, for example, that would help them source exactly what they're looking for. That's what you do. You build portfolios for people.
Yeah. And so, my job as a wealth advisor is really to get to know our members. And so beyond just getting to know who they are and what they love and who they love, we tend to dip a little bit into, what's sort of the cultural alignments for us, right? So what's important to them, and typically things like the environment or gender inclusivity, I should say, diversity, governance of companies, being on the right side of history. Those come up in conversations about things they want to see in their portfolio. And from my point of view, yeah, then I'm sourcing them out and finding an appropriate investment, appropriate manager who's going to implement those for them.
Yeah. Okay. So the big question is, are you getting as good a return on your money with ethical as you do with the others? We're going to talk about that next. Our guest on Chamber Chats today is Daniel Marley. He is a wealth advisor with Island Savings, and we're talking about ethical or responsible investing. So people are going to make that switch over, Daniel. They want to be more ethical, more responsible. And are the returns as good on that as on ones that don't qualify?
Yeah, and so I think this is one of the biggest differences from the origination of these investments back in the late 80s, early 90s. These ethical investments were really built around, solar farms and windmills, and we were happy to lose money if we were saving the planet. Today's investments are really built for both the social and environmental benefits as well as the financial return. So they're judged against standard benchmarks. They're judged against peers who don't implement these investments. So, most listeners will be familiar with like a balanced mutual fund. Balanced mutual funds may have the ESG rigor in it. They'll be compared to ones that don't. And so you get that apples to apples comparison in terms of returns. There's studies starting to come out now over the last 10, 15 years that make arguments that putting these rigors in your portfolio can actually help returns. So think about having equality on your board of directors, lots of studies going into female CEOs and how they can improve returns over a long period of time. But really what we're looking at here is avoiding pitfalls. So again, if you've got a large polluter in your portfolio, this transition as we go to net zero is obviously going to be a negative for their business, right? If you have a poorly run company, you've got, share structures that might not be aligned with shareholders. You're going to run into issues that over the longer term may actually be detriments to your portfolio return. So there's lots of studies coming out now that say that, putting these riggers in your portfolio are actually going to be a net benefit longer term. And I think the biggest one is that demographically, right? We're seeing a shift toward energy transition, AI and IT efficiencies, gender equality, women empowerment, sustainable agriculture, waste management, like all these themes, there is money pouring into those industries. And so, there's lots of arguments being made right now that this is where the growth is going to be over the next, couple of decades.
Yeah. Is there any difference in the fee structure in any of these transactions?
Yeah, it's a great question. So there's not. So if you're doing this yourself and you're buying, an ESG ETF or a mutual fund, you're going to pay the same commissions with your broker as you normally would. From my point of view, in terms of management of the fee, advisors aren't compensated any differently between an ESG mutual fund or investment, or a fee-based platform would be the same. So costs are going to be comparable. There's always kind of a rush to be the lowest cost investment, and that's not usually always the best solution. But we look at those after fee returns, and very comparable.
Most professionals like you would counsel people to be in this for the long run, right? You got to wait things out, sit through the ups and downs of what's
Certainly,
going to
yeah.
happen. But a lot of this stuff we're talking about now, the ethical stuff, a lot of it kind of rockets up pretty fast, doesn't it?
It can, yeah. So we've seen, short-term returns for things like AI technology companies. A lot of those companies are advocates of net zero, like a Google, like an Apple, have done very, very well here in the short term. Obviously, we don't have a crystal ball. We don't know what the short term is going to look like. But we certainly look at the returns of the investments, both short term in terms of volatility as well as, total returns. But yeah, you're really looking at the long term for this. The real opportunity in ESG, or impact investing is really that thematic one, right? This idea of a just transition. There's some stats around hitting the global sustainability development plans. So that's the sort of net zero by 2035, the 1.5 degrees by 2050, all those numbers that
That's the
get thrown
UN
out.
thing? Is that from the
That's
UN?
the UN sustainability numbers. That's right. And the business opportunity for that, I've heard numbers as high as $12 trillion between now and 2030. They're talking about it creating about 380 million jobs in those industries, right? So these are growing sectors, but thematically or impact wise, it really is the longer term that you should keep your eye on. But again, short term returns have been there as well.
Yeah. We've mentioned ESG. Let's unpack that a little bit about what's involved in that definition
Sure.
exactly.
Yeah. So the big catch-alls obviously are environmental, social, and governance. But you just mentioned the UN sustainability goals, and so those goals when they were launched, I think there was 14 or 15 of them. There's now 17, right? And they run the gamut of everything from poverty to hunger, education, gender equality, obviously then going to climate, whether it's land, oceans, right? And the big thing with those sustainability goals is that they need to be measurable. They need to be intentional. And so we're really starting to get some solid numbers now around the impact that those ESG buckets are going to have. And so anybody who wants a little bit more information on that can look up the UN Sustainable Development Goals. But most of the investments now that are dealing in the responsible investment realm are detailing the measurability of these goals. And they're putting them out every once in a while, usually annually, to say here is actually the actual impact of those portfolios.
Yeah, another term we hear is SRI. Tell me about that.
Yeah, yeah, socially responsible investing. It's sort of interchangeable
Hmm.
with ESG. Going to have lots of acronyms anytime you're talking about investment, but you'll hear green investments, sustainable investments. They're all going to kind of swim in this realm. It's important to note that greenwashing has obviously come to the forefront, and greenwashing kind of speaks back to that depth you were talking about, Bruce. So there's individuals who might buy a socially responsible investment, and the expectation would be that there's no oil and gas in that portfolio, or there's no China in that portfolio, and that's not necessarily the case with all responsible investments. And so greenwashing is really purporting yourself to be on the right side of a lot of these conversations, whereas the portfolio, how it's constructed, is really not doing what investors think it's doing.
And the mention of China there, that's freedoms, right? Political freedom and that sort of thing that's not a part of the culture that yet. It's a huge economy too. I mean, it's hard to
Yeah,
avoid China, isn't
yeah.
it?
Yeah, and so it used to be human rights. As they were moving sort of toward that social democracy, it was really a kind of a supply chain issue. Apple's run afoul of it. Loblaws in Canada has run afoul of it in the past. But realistically, what this is now is about democracy. It's about freedom. It is that idea around that free economies are efficient economies. Frankly, at this point, in terms of the environment too, they're very heavily reliant on coal. And so you look at a lot of the factories that are producing goods there, and just on the being on the right side of climate, they're not at this point either.
Yeah, there's a fair number. South Africa, for example, gets the majority of its power from coal, which
Yeah.
my partner Amanda is South African. We've gone there to visit family, and that's
Yeah.
one of the things I found out when we'd already got there, that there's so much reliance on coal. So it happens elsewhere in the world. What's this done sort of seismically to the whole investment world, that people are looking more at these ethical choices?
Yeah, I think again, demographically speaking about it, I'll kind of speak to the millennial group. So millennials are obviously due to are inheriting the largest intergenerational wealth transfer that we've seen in history. More recent numbers that I've seen is about 61% of millennials are already in these ethical investments, impact investing. It's sort of table stakes for them. They really take the social and governance impact of their portfolios very seriously. And so as we start to see that intergenerational transfer, and obviously as things like climate change, human rights, geopolitical issues continue to come to the fore, we're seeing more and more money migrate to this. And so the last number I saw was between 2017 and 2022, the industry for SRI investments, socially responsible investments, has gone up about 81%. So it is changing the landscape. It is changing the conversation. Whereas we were just returns, returns, returns. We're now talking about the good your portfolio can do beyond those returns. And those conversations they're satisfying for members, but they're also satisfying for advisors. You go through periods of challenge like 2022 when investment returns, both in stocks and bonds, were kind of falling. You could relay back to say, but look at all the good the portfolio is doing. And it can give members or investors a longer term view of what their money's doing,
Yeah.
and doing some good.
We want to also talk about things, you've sort of mentioned some of these: weapons, armaments, guns, gambling, pharma, tobacco, alcohol, cannabis, manufacturing, and there's more to talk about with oil and gas. We're going to talk about that next. We're talking about ethical investing today, taking a responsible path with your investment into your portfolio. And we're doing that with Daniel Marley, who's with Island Savings. Um, the oil and gas thing, we see a shift over now to electric vehicles. There's more and more of that happening all the time. Where does mining fit into all of this, though? Because mining is necessary to create these EVs too, right?
Yeah. And so we sometimes refer to this as natural capital. There's lots of carbon emissions that are, being reduced in that industry, but they're obviously still very much at the forefront. We do talk about things like water use as well. So in mining, beyond just the CO2 emissions, there's lots of water being used for that. And we have a tendency to kind of lean in oil and gas and mining as being the big issues for that. But, little do we think about the production of things like semiconductors and the cooling of data centers, right? So CO2 emissions are part of it, obviously, but it is also the use of water, the stewardship of land. One of the things that these investments do is they really do work with local communities to see impacts there. But it's important to note that we're looking at a just transition as well. So even though you can exclude things like mining and oil and gas from your portfolio, they're included in a lot of these portfolios like a clean infrastructure fund for the sole purpose of realizing that some of these communities rely on those businesses still. And what we're looking for is gradual improvement toward, again, net zero, as opposed to sort of an exclusion, which might be done to the detriment. We're seeing this a lot in Alberta right now, where communities are obviously concerned. We see it quite a bit with forestry here on the island as well, where people are relying on those jobs. And this is kind of a way through socially responsible investment to sort of diversify a little bit. If you're making your earnings in those sectors, you can then start to invest in things that are either moving in a just transition away from that, or in some cases excluding from it. But yeah, they're taking into account all of those in the investment choices.
Yeah, I mean, we know that tobacco is bad. What about cannabis? Where does that lie?
Yeah. So tobacco and cannabis are both exclusions in most portfolios right now. they're still out right now whether cannabis is going to be used longer term for health purposes. But I haven't seen cannabis come up in any of the portfolios that I've come across for ESG. Yeah, and so it's kind of fallen in with tobacco as being one of those exclusionary pieces.
Yeah. Pharmaceutical companies, some
Yeah.
people rely on them, they think, to keep them alive and the products they create, but it's not all good, right? I mean, is pharma in this conversation?
Yeah. So, and it obviously came to the forefront during the pandemic.
Yeah.
People that saw the benefits of pharma at that point in time in terms of innovating a vaccine, and then obviously, some people who are sort of reticent to take it. And so we've seen it from both sides. I think one of the important pieces with these investments is around active ownership. So you look at a company like Purdue Pharma that got themselves in trouble with the opioid crisis, right? There was clearly some bad actors at that company who were obviously soliciting a product they knew had negative impacts, right? And so from that perspective, a Purdue Pharma would have been kind of fished out, I think, through that active ownership piece. So when I say active ownership, what I'm talking about is that a lot of these pension money managers, mutual fund companies, they'll vote your shares as sort of as a proxy vote, so in your place as a group, and they do that to try and um, obviously influence management teams to move in a better direction. They might do it to put themselves on the board of directors to be able to have a vote on where things are going, but they also work with public policy makers to try and regulate, if you will, for lack of a better term, a lot of things. So pharma, as though it's not an exclusion from the portfolio, would fall into a lot of that active management piece, right? They're really working with these companies to try and ensure that there is that transition away from harm to doing the good that they can do.
Yeah, I mean, when you look at alcohol, tobacco, drugs, in some sense, they are also addictive substances. So is
Absolutely.
gambling, for that matter. Gambling is a very bad thing
Yep.
for a lot of people. How much is age a factor in people making this choice in their portfolio going forward? Is it more younger people that are adopting this, or is it across the board?
Yeah. It is at this point in time. So we see the highest sort of uptake from the millennial generation, and as you kind of move up those age demographics, it tends to lessen. What I will say is a lot of the conversations that we're having, whether it be the pandemic, whether it be the climate, whether it be geopolitical, is that I'm seeing a lot of retirees, a lot of boomers right now who are controlling a bulk of those. Those investment assets right now as they move into retirement and through retirement, those conversations are becoming much more prominent. So I would say with that demographic, I was not having this conversation 15, 20 years ago. And those conversations are becoming much more prominent amongst older generations who maybe didn't think about it in the past.
Yeah, it's never too early to start investing. It's also never too late to start investing. And that's why people need to talk to somebody like you. Daniel, thank you for
Absolutely.
your time. We appreciate it very much.
Yeah, thanks for having me, Bruce. I really appreciate it.
You bet. Daniel Morley is a wealth advisor with Island Savings. And I'm Bruce Williams. We'll see you again for another Chamber Chat.